In this video, we're going to look at other techniques for investing in capital projects for a corporation. Before we get that far, let's talk about just a way to kind of identify projects or categorize them, if you will. Mutually exclusive projects are projects that when you choose one project, the other projects are eliminated from consideration. Think about if you want to buy a new pizza oven for your pizza shop, you're going to probably look at 3, 4, 5 different pizza ovens. You're going to look at them, look at their benefits, the way they work, the way they'll fit into your business, a variety of issues. But in the end, you're going to have to identify the benefits and compare those to the costs. Which one of those is the best? That is the definition of mutually exclusive. Ranking projects, selecting the best. So under the net present value rule, you would select that project with the highest net present value. Now, if you use the internal rate of return rule, what you have to understand is it's going to rank projects differently. It's still going to give a select or reject decision when you're done, but which asset is it going to identify as being the best? It is going to vary, right? So it's going to have there's going to be some differences with mutually exclusive projects. Independent projects, imagine you only wanted to buy one thing, right? And you say, I'm going to buy that car over there. Right? You know exactly what it is, and you're going to find out whether or not it's a good idea or a bad idea. That's an independent project. If projects are independent, net present value and the internal rate of return rule will agree with respect to selecting or rejecting projects. So let's work our way through some projects. We have 2 projects here. You notice that they're difference in size. The discount rate, the required return is 15%. We'll talk about this reinvestment rate a little bit later, but here are the cash flows that we have predicted for these 2 projects. So we want to identify or talk about the answers, right? What does capital budgeting tell us about these 2 projects? Well, here you have the examples, if you will, and I'm going to make this just a little bit bigger so we see the numbers a little bit better, right? So here are the answers, if you will, to our techniques that we're going to use or talk about. So in this case, so we can see the thing. If you can do both projects, which one would you do? And if the projects are mutually exclusive, which one is the best of the 2? So we're going to work our way down through these techniques and talk about each one, the pros and cons, and what it makes, how that affects or impacts the decision making in the company. The first technique is called the payback period. Now, this is the amount of time that it takes for you to recover your money. Right? It's the payback. How long does it take to get this back? If the payback is less than the required time, you accept the project. And this payback rule is used by lots of companies because it's simple. In fact, the smaller the company, the more likely payback is the one and only rule that they use. Now, the challenges with the payback technique, though, are it ignores the cost of capital. We don't consider it at all, or the time value of money. It ignores cash flows that occur after the payback period. And quite frankly, in the end, I think this has the biggest impact on using this decision is it will have an influence on our strategic plan, right? Because it is an ad hoc decision, right? We decide what the payback period is, right? So we say, look, we're not going to do any projects unless we get our money back in 3 years. That's our ad hoc decision. How did we come up with 3 years? I don't know how we came up with 3 years, but 3 years is the number we're using. The challenge is if you choose a rule that is too low, then it's going to be very difficult to do any really big projects. Big projects cost lots of money and require time to get that money back. However, if it's too high, then almost every project you can think of will be acceptable, right? So this will have an influence on expansion or contraction of the company, depending on how we use this particular technique. And it should be used. We should look at it. All of these techniques, as you see with the previous slide, it's just an answer, right? It's a formula that you use. So getting the answer is not all that difficult. Using the answer is the important part, obviously. So here we look at the two examples. Project A, payback period is 2 years. Project B, it's 3.3 years. So we have a benchmark that says, look, we're not going to do any projects unless we get our money back in 3 years. So in this case, project A is acceptable. We get our money back quicker. In this case, project B, it's not acceptable because it takes longer to get your money back than the benchmark does. So now moving forward, right? What else can we do? There is another technique here that's the discounted payback. The discounted payback takes care of the pitfall that we talked about using the cost of capital and the time value of money. But still, in this case, you can see that, excuse me, project A is still less than 3 and B is greater than 3. So payback period says A is good, B is bad. So we really don't have to think about mutually exclusive or independent here because one project is clearly not desirable. So now let's go back to this internal rate of return rule and let's try to understand why it gives different answers than the net present value rule. So if a project size is doubled, its net present value will double. However, the internal rate of return rule will not change, or the internal rate of return answer will not change. If you double the size of the project, net present value doubles, but the internal rate of return remains the same. So the internal rate of return rule cannot be used to compare projects of different sizes. If they have different sizes, you're going to get different answers. Another problem with the internal rate of return is it can be affected by changing when the cash flows occur and the scale, the size. So internal rate of return is a return, but the dollar value of a given return depends on how long you earn that return. So again, the scale of the project and the size of the project or the timing of the project, they will affect the internal rate of return and create these conflicts for us. The final problem, and I think this is really kind of important, I guess, in the end, is about the timing of cash flows. So again, the internal rate of return is a return, but the dollar value of earning the return depends on how long it's earned, right? So again, the longer the time frame will have an impact on internal rate of return, but will not have an influence on net present value. So in the end, what does this mean, right? So an internal rate of return that's attractive for a safe project is not going to be attractive for a riskier project. So it could be higher than those of the other investment opportunities, yet the net present value could be lower. So the higher cost of capital means a higher internal rate of return is necessary to make the project attractive. So again, differences in risk, differences in size, differences in timing and scale, etc. Those things all influence internal rate of return and can cause it to give us a different answer than net present value. So how can we relate this, right? How can we understand how this all works, I guess? There is an internal rate of return rule that we can apply that will help us look at two mutually exclusive alternatives and decide which one is better of the two. Now, sometimes you can do this just by looking. You don't have to get into this kind of detail, but this is just a process. So you have a company, you're either going to do a major overhaul or you're going to do a minor overhaul. The major overhaul costs $10 and returns $6 each year. Minor overhaul costs $50 and it's $25 a year. So here's the question, what's the internal rate of return of these projects? And if the cost of capital for both projects is 12%, what should your company do? So let's look at this. Comes from another worksheet. It's called the Capital Budgeting Project Analysis Worksheet. So here is Project A. We spend 10, we get 6s, 12% is the discount rate. So what you can see here is the net present value is 4.4. The net present value of Project B is 10.05. Again, negative 50 and 25, right? So let's look at the internal rate of return, though. Again, the internal rate of return, and the purpose for looking at this, is flip-flopped, right? 36% for A, 23% for B. So obviously, the higher rate of return goes with Project A, but the greater wealth building goes with B, right? So how do we do this? On the far right here, we have an example. What we do is we do what's referred to as an incremental cash flow. You take cash flow from one, you subtract from it the cash flow B. So negative 10 minus a negative 50 is 40, and vice versa. 6 minus 25, negative 19. So here we have our incremental cash flows. If you calculate the net present value, negative 5.63. So what that means is, should you do Project 1? Well, Project 1 says no, right? If you do Project 1, the net effect is you have a loss in wealth. And again, we showed that with these two columns. The nice thing about this is it gives us a crossover rate. Essentially what this tells us is, at what interest rate, at what cost of capital would these two projects have equal net present value? So if the cost of capital were 20%, both of these net present values would be equal. And if you do this project, if you look at it and play with it in Excel, plug in 20%, 20.04%, and see if it actually happens. So here are these two projects again. And what we're looking at is the differences, right? Net present value is what we're measuring. That's the important concept or technique. So what is the net present value at these variable cost of capitals? If you remember, we called this a net present value profile. Notice the negative slopes, but one is much steeper than the other. So this brown slope is the major overhaul. The net present value for that obviously is identified as cost of capital increases. Down here, where it crosses 23.4, that is the internal rate of return for the major overhaul. Here's the minor overhaul. Internal rate of returns 36.3%. 20.5, that's where these two cross, is 20%. But the important part to understand here is it kind of shows us how these things flip-flop, right? Anywhere to the right, anywhere to the left of the crossover point, the major overhaul was a better project than the cost of capital. So if we have relatively low cost of capital, less than 20%, the major overhaul is better because it has a higher net present value. Once we get to the right of that, though, everywhere to the right, the minor overhaul has a higher net present value than the other asset, right? So this shows again that it changes dependent on what? Changes on the risk of the asset, the riskiness of the company, how it's being financed, right? The project itself as risk changes. So again, this basis of our understanding here is just to look internal rate of return. You really have to look when you're comparing projects. You really have to understand and look at the relationships to make sure you've chosen the correct project. So what are the shortcomings of using this incremental internal rate of return rule? It might give us an IRR that doesn't exist. It could have multiple incremental IRRs could show up. Again, the fact that the internal rate of return exceeds the cost of capital for both projects doesn't mean that either project has a positive net present value, right? And finally, when individual projects have different costs of capital, what do? Right? What if these two projects have different risk levels? If you kind of think about it, both of these projects probably do have different risk levels, right? You could do something minor, put some Band-Aids on, see how that works, or you can go and do a full-fledged rebuild of the asset. The rebuild of the asset should be safer in the long run, where the Band-Aid fix might not be the most usable or most friendly to use type of project. So we have another technique to talk about, and that's called the modified internal rate of return. And this technique is not in your textbook, but it's a fairly simple way to follow. Essentially, what this project does is it calculates the net future value of those future cash inflows using that reinvestment rate. So we assume in this case that they're the same, but they could be different, right? So when you get these cash flows in the future, what do you do with them? You reinvest them. What do you reinvest them at? What is the rate of return? Well, we need to forecast these future interest rates and then try to determine, if I reinvest them, what will the value of all of those investments be at the end? That's what's referred to as a terminal value. So now we have two values. We have a present value, which is the cost. We have the terminal value, which is the investment, the reinvestment of cash flows. And we have the reinvestment rate of return. So the question then is, right, what is the modified internal rate of return? We have the time frame. We need to solve for the return. So this is going to solve most of the problems with internal rate of return, because it's going to give us a single answer and to give us specific rates for borrowing and reinvesting the capital of the firm. So let's look at what this looks like. Here's the modified internal rate of return, 22.06%. Down here, 24.178. Again, both of these projects are greater than 10%, so we know we are 15%, so we know they're good projects. But in this case, modified internal rate of return is better than A. And if you look at net present value, indeed, we see that net present value is better for B. So looking at these two projects, net present value says there's no question. Right? B is 3 times better almost than A. So we need to do B. If you look at internal rate of return, we have a conflict. If you look at the modified internal rate of return, it straightens it out a little bit. Now says that B is better and it agrees with net present value. I'm not saying that that works every single time, but in this case, it definitely works and straightens out the issues with internal rate of return. The last technique we have is something called the Profitability Index. Sometimes we use this to kind of break ties. It gives us a picture of how are we using our dollars, right? Are we good stewards with our shareholders' money? In this case, you take the present value of the future cash flows and you divide it by the investment. So if the benefit is greater than the investment, profitability index will be greater than 1. So if the profitability index is greater than 1, you do the project. Less than 1, you don't do the project. And as we see here, both projects are greater than 1. And indeed, right here, so it shows us, in this case, project B is better than project A. So those are the basic techniques. There are a few others, but these are the basic techniques used in capital budgeting.